Hello everyone, hope you all are doing well. So today we are going to discuss question number 3 of December 2022 and the question name is Marlos Company. In the previous two videos, we have covered question number 1, Mercurio Company, question number 2, Cobalt Company. Now this is day 3rd of December 2022 past paper. This video will also be uploaded on ACCA PassPoint channel under the topic-wise past paper block list. And in that playlist, you can watch this lecture also. Okay, let's read about question number 3. It is 1st July 2005. Remember, dates are very important. It is 1st July 2005. You are the manager responsible for the audit of Marlos Company, and you are completing the audit of the financial statements for the year ended 31st March 2005. Marlos Company is a listed company operating in the retail industry. Highlight this word is a listed company and operating in a retail industry. The audit field work is nearly completion and the auditor's report is due to be issued in 4 weeks' time. Means we are done with the audit work. The following exhibit, this one, available on the left hand side of the screen provides information relevant to the question. Audit matters, summary of the key matters the audit supervisor has flagged for your attention. The information should be used to answer the question requirements within the response option provided. Let's read the requirements. There are two requirements. Usually question number 3 cover two requirements and the requirement 1 about the evaluate the matters to be considered on the completion. Previously, the matters we have considered were about the planning state, means client integrity, communication with predecessor, but these matters about the completion of the audit and the audit evidence. This is same as the audit risk questions. If you watch my Mercurio company past paper video, then you will get the idea. Question number 3 is similar to question number 1, audit risk or risk of material misstatement. Same in question 3, you have to identify the risk, then you will explain the accounting treatment, then the issue and its impact. So evaluate the matters to be considered on the completion of the audit and the audit evidence you should expect to find during your review of the relevant audit working papers. In part A, we have to answer two things. First, the matters on the completion and the audit evidence. Note, the following mark allocation is provided as guidance for this section. Part 1 lease, part 2 inventory, means we have to identify both matters and evidence for lease and inventory. Part B, evaluate the implications for the auditor's report of Marlos Company, assuming that the inventory matter has been satisfactorily resolved, but that no further adjustments or disclosures are made to the financial statement with respect to the lease. This is for the 4 marks. So if you write your answer correctly, then you will get 20 marks. If you cover professional skills, then you will get 5 marks also. Let's go through the exhibit. Okay, this is the exhibit. The draft financial statement recognized total assets of 118 million and profit before tax of 1.5 million. I told you so many times, whenever in your question there are figures of PBT, total assets and total revenue, so it means you have to calculate the materiality. But I have also mentioned that if the materiality has been set or given by the examiner, then you don't need to calculate the materiality. Now in this case, the materiality has been set for the audit at 1.1 million, so we should use this materiality for both the parts, inventory and lease. Let's read the first part, lease. New property lease. Marlos Company expand operations during the year and as part of this process arranged on 1st April 2004 a new property lease. Okay. The lease contract is for 7 years with a rent-free period of 12 months followed by 6 annual rental payments. The contract meets IFRS 16 leases criteria to be classified as a lease. Means IFRS 16 criteria is meet, and the criteria is it should be a significant lease, there should be a exchange of consideration, payment terms must be defined correctly. The financial statements recognize a right of use asset of 28.9 million. As Marlowe's company is a lessee, so that's why they have recorded a ROUA and a corresponding liability of the same amount, which has been correctly calculated at the effective interest rate implicit in the lease agreement. Management has not charged any depreciation on the right of use asset. This is wrong. They should have to charge a depreciation. Starting that the rent-free period should not result in an expense being included in the statement of profit or loss. Management proposes to begin depreciating the right of use asset in the next financial period and will depreciate the asset over the 6 years for which they make payments. This is a wrong judgment by the management. The finance cost in relation to the lease liability has been correctly accounted for in the financial statement. So only the difference is about the depreciation, and finance cost means interest is correctly recorded. Now, first solve part A for the lease, then we will move to the inventory. Okay, so here is the answer guidelines for you. Marvelous Company, December 22, question number 3, important points. Question number 3 covers 25 marks, 5 marks are professional marks, whereas the 20 marks for the answer. Part A for the matters to be considered on completion. Block 3 YouTube playlist ACCA PassPoint, in which you can watch the block 3 lectures. Part B for the reporting implications or critical appraisal. Critical appraisal means sometimes the examiner gives you an extract of the report, and on that you have to comment whether the extract is correct or not. We will solve such questions on this topic as well. YouTube playlist ACCA PassPoint. Give headings to each paragraph for securing professional marks. In this question, the professional mark will be awarded for the demonstration of skill in analysis and evaluation, and professional skepticism and judgment in your answer. Analysis and evaluation woven through both sections. Contextualize everything. Use scenario details to assess financial, ethical, legal, regulatory issues. Investigate, locate key facts, calculate materiality, perform analytical procedures. But in this case, the materiality is already set, so we don't need to calculate the materiality. Evaluate, appraise impacts and trade-off implications of not adjusting a misstatement. Part B. Draw conclusions and link analysis to actions, recommendations, flag gaps, highlight missing data, and suggest further audit procedures or information needed. Professional skepticism and judgment. Question and challenge assumptions, estimates data reliability from client and scenario. Apply spectrum of risk, identify, prioritize, and justify highest ROMM. Reflect on sufficiency of evidence. Part A, requirement number 2. Basis of provisions, amortization policies. In this case, we have to discuss the depreciation policies rather than amortization. Justify priority ranking. In conclusions, show professional judgment. Communicate commercial acumen, understand client context, business model, sector, external environmental factors. Now solve question 3, part 1, leases. First, you have to write a heading about matters. The amount of the right to use assets 28.9 million and depreciation 4.13 are material to the financial statement, as they are above the materiality amount of 1.1 million. If you write this statement about the materiality, you will fetch 1 mark. After that, you will have to write the accounting treatment, accounting policy of IFRS 16. As per IFRS 16 lease, the lessee should depreciate the right to use assets from the date when the asset is transferred to the lessee. Therefore, and in that case, the date is April. Therefore, in this case, depreciation of the ROUA starts when asset is transferred to Marlowe's over its useful life of 7 years. However, management is reluctant to charge the depreciation over 7 years is incorrect. Once you write this thing means you cover the accounting treatment or accounting policy Now, depreciation should be charged over 7 years, irrespective of a free rent period of 1 year. Therefore, you have identified the issue, the risk. Now, therefore, there is a risk of understatement of expenses as depreciation is less charged, and overstatement of ROUA. Of course, if there is a less depreciation, then ROUA will be reduced by less amount. So there is an overstatement of ROUA. Further, Marlos Company is a listed entity. This is very important. That's why I told you earlier that you have to highlight this thing. Marlos Company is a listed entity. There is also a risk of management bias, as management bonuses might be linked with profitability. That's why management is reluctant to charge the depreciation over its useful life of 7 years. This should be dealt skeptically by the audit team as the effect is material. Now look, it's very simple. All you need to is the drafting technique. Learn the art of the linking and the drafting technique. Once you start solving your questions and watch these videos, then you will be on a right track. Now, evidence. Remember, if you watched my lecture on the evidence, I talk about whenever we are writing or giving answer on the evidence, we always use the word copy. Copy of lease agreement, copy of bank statement, results of recalculation, notes of discussion, these things. Okay. Copy of the lease agreement to confirm the useful life of the assets and the lease amount of 28.9 million. Notes of discussion with management to confirm the basis of not charging the depreciation. We obtain the notes of discussion with the management to confirm why they are not charging depreciation over 7 years. Is there any other reason, as we have mentioned in this line? Copy of the bank statement to confirm the payment of the lease amount, results of recalculation of the depreciation expense to confirm the accuracy of the management calculation. Discuss with management the basis of recognizing the ROUA in the current year's financial statement, irrespective of the useful life of 6 years. Now, question number 2 about the inventory. Let's read the inventory part. Inventory. Marvelous Company has recently negotiated arrangements with a new supplier. Included in the contract is a clause which allows the supplier to require return of the products at any time. Marlos Company can also return the products. Marlos Company can also return the products within a set period of time if they remain unsold. Inventory purchased from the new supplier with a value of 8.1 million is included in the company's financial statement. As inventory at 31st March 2005 means year end, these amounts are recognized at cost, which is lower than the NRV of the product. We all know inventory shall be measured at lower of cost or NRV. But there are few things which you have to highlight. Let's read again. Marlis Company has recently negotiated arrangements with a new supplier. You have to be take this thing in your mind that Marlos is a retailer, not a manufacturer. Okay. Included in the contract is a clause which allows the supplier to require return of the products at any time. Means it's written in the agreement which allow that the supplier require return of the products at any time. Marlis Company can also return the products within a set period of time if they remain unsold. Means whenever there is something mentioned that the retailer has a clause or has a right to return their products to the manufacturer, it's a consignment basis. Means inventory held on consignment or consignment arrangement in which the manufacturer provides the inventory to the retailer. Retailer display the inventory on their shops or whatever you can say kiosks. After that, if the retailer are able to sold the inventory, then only the manufacturer will deduct or will remove the stock from its book. Otherwise, the manufacturer can't ignore or can't remove the inventory from their books. So this is the case of consignment arrangement, okay, in which the manufacturer still has the right of inventory. Till the time the inventory will not sell, manufacturer can't remove the inventory from their books. Inventory purchased from the new supplier with a value of 8.1 million is included in the company's financial statement as inventory at 31st March 2000 X5. Okay, let's go through the answer. So inventory, the amount of inventory 8.1 million is material to the financial statement as it is above the amount of materiality, that is 1.1 million. As per the IAS2 inventory valuation, inventory shall be measured at a lower of cost or NRV, and it should only be recognized if the entity has control over the inventory. Look, this is very important, and it should only be recognized if the inventory has control over the inventory. Since the supplier has the right to demand the inventory at any time, Marlowe's company may not have full control over the inventory. Just assume this thing that the supplier is the manufacturer and the inventory belongs to that supplier, that manufacturer. So it means Marlowe's company is a retailer, so Marlowe's company does not have control over the inventory. Also, if Marlowe's company does not have full control over inventory, it should not be recognized as an asset. You can write about current asset. Instead, it may be classified as a consignment arrangement. Furthermore, if Marlowe's company has if Marlowe's company has control, but the supplier has the right to return, Marlowe's company should record the provision for return as per IAS 37. If you don't want to write this thing, no problem. As far as you covered the IAS2, then it's okay. Therefore, there is a risk of understatement provision and overstatement of assets, which is due to recording of inventory at cost. Let's read the evidence. Notes of discussion with a new supplier to understand and confirm the negotiation arrangements. Copy of the contract to confirm the clause under which the supplier requires the return of the products anytime. Copy of the bank statement to confirm the payment of 8.1 million related to inventory purchase from a new supplier. You can also obtain the copy of the purchase agreement or the clause agreement. Look, I have written this point into. Discuss with management the basis of recognizing the inventory in the financial statement and cost instead of recording it as consignment arrangement. Copy of the sales invoice on a sample basis to confirm the actual sold units of the inventory. Now, part B, implications for the auditor's report. If you remember, there is mentioned that the inventory is correctly recorded, but there is an issue with new property. Let's solve this. One, implication means action. So what will be the response? What will be the course of action? As the effect is material, we have calculated above in least part. As the effect is material to the financial statement, auditor shall request management to correct this misstatement before signing the audit report. If management is not willing to correct this misstatement, auditor shall request the TCWG, those charged with governance, to communicate the management to correct this misstatement. The auditor shall also inform the TCWG regarding its possible implication, means implication on the audit opinion or report. In the audit opinion, if the matter remains unresolved, then the auditor shall express a qualified opinion in the opinion paragraph. Opinion paragraph means the paragraph in the report. You have to watch my lecture of block 3 on the audit report and its implication. The reason for the misstatement shall be mentioned in the basis for qualified opinion paragraph, followed by the qualified opinion paragraph. Basis for opinion paragraph comes after the opinion paragraph. So What I am thinking, I will, once I upload this video on the YouTube, so I will attach the all other links of the topics which are linking with this question. You will see the link of the playlist here, and it might be there. Okay. So also the auditor shall include a key audit matter. Why key audit matter? Because it's a listed entity and it's a significant matter. In the audit report in which a reference to the qualified opinion shall be mentioned. Also, the auditor shall re-evaluate the integrity of the Marlos company for the next year's engagement before accepting it. Now, inventory. As the misstatement has been resolved, auditor shall express an unmodified opinion in the audit report. The auditor shall also include a key audit matter paragraph in the audit report to communicate the matter to those charged with governance as it is a significant matter. You can write more points if you have any in your mind. So, best wishes. Now, if you can see there is a concept of consignment arrangement, I can understand most of the students did not get this concept and they may face difficulty once they try to solve this question by their end. So what I have done, I have written down the concept of consignment arrangement at the end of this slide. So you can go through this concept. It's very easy and very important for your clarity. And once we move to the further questions, and if I feel that there are any concept on which I have to write down a summary point for you, so I will also do the same for that concepts as well. So take care and best wishes. Please stay aggressive and do your practice well as your exam dates are near. One important thing, if you are facing issues in IAS or IFRS lecture, I have also a updated playlist of IAS and IFRS lecture, which I will also give a link on this video lecture. It could be here and there. Okay, with the name of SBR important lectures. Take care and goodbye.